Hello everyone, Professor Christensen here. Welcome to this chapter overview video where we're going to be taking a look at chapter 11, which is all about current liabilities. So after this chapter, you should be able to account for current liabilities of known amounts, calculate and journalize basic payroll transactions, and use the times interest earned ratio to evaluate business performance. So by way of review, let's talk about current versus long-term liabilities. Remember that a current liability is a liability that has to be paid within 1 year or the operating cycle, whichever is longer. Most often it's 1 year. And long-term liabilities are due in over a year. So just also by way of review, the operating cycle, remember a company starts with some cash, they buy some inventory, then they sell the inventory and get an account receivable. Then they collect the account receivable and get cash again. So most companies have many of these every year, but there are a few kinds of companies that might not have an operating cycle in 1 year. For example, if a company is building a bridge or something that takes much longer than a year, then they might have an operating cycle longer than a year. For the most part, you can use this pay within 1 year. Now let's look at accounting for current liabilities of known amounts. First, we're going to remind ourselves of unearned revenue, which is money that has been received from customers before goods or services have been provided. And then sales tax payable, which is money that when you go into a store, right, you know what sales tax is. It's money that's from customers that's paid to the company, but that money actually belongs to the government, so that has to get paid over to the government. Unearned revenues, remember what we said, that the customer pays before goods or services are provided. Think of buying season tickets to some kind of anything, to a sports team or something, right? So you pay the sports team has unearned revenue. So unearned revenue increases when the cash is received from the customer. It goes down, it's decreased when the goods or services are provided. So say you buy tickets to a football team. So in the US, United States football teams generally play 16 games per season. And then there might be some games after that, but they have played 16 games, 8 of those would be at home. So say that you paid for your season tickets. Every time the team plays a game, they would earn 1/8 of what you paid them, right? And so the unearned revenue goes down when the goods or services are provided. We studied that back when we looked at adjusting entries, if you might remember. Now, sales taxes payable we haven't really seen before, and remember, it comes from the customers and then it belongs to the government. So we increase sales tax payable when the cash is received from the customer. So a customer comes in, they buy something, and they pay sales tax. And so the company credits sales taxes payable. And then, just like any other liability, when the company pays the money to the government, then they decrease the sales taxes payable. Now, notes payable are a little bit more complicated because they involve interest. So remember that a note payable is a note that the one party promised somebody, one company or one entity borrowed money, promises to pay the money back plus interest, right? And so there's a signed document that the company promises to pay back the money, or the individual pay back the money plus interest. So from the company's point of view, when they owe the money, right, they're the borrowing company, when they owe the money, they record the interest either at the end of an accounting period, if they still owe the money, they make an accrual, or they record the money when the note is paid, all right? And the amount of interest is the principal times the interest rate times the time in fraction of a year. Now, let me tell you from teaching this for many years that students generally don't have a problem with principal because that's the amount that was borrowed, or the interest rate because that has to be given to you. The fraction of the year part is the thing that sometimes gives students trouble. So remember that this is either going to be out of 12 months, so say it's a 6-month note, you multiply by 6/12 to find the interest for the whole note, or it could be in days, and then you would divide by 365. So remember that your denominator is either going to be 12 or 365. Now here is a QR code to a notes payable video that might help you. That goes into a little more detail regarding notes payable. Feel free to pause this and link to that video. Now let's talk about calculating and journalizing basic payroll transactions. So first, some payroll terminology. Now if you have a job, you're probably familiar with these terms. So there's salary versus wages. So salary is an amount that's generally paid for a year. And no matter how much you work, you still get the same salary. So I have a salary, and no matter if I work 40 hours, 50 hours, 60 hours, I still get the same salary, right? Now wages are different because wages are paid hourly. So if you have a job putting yourself through college, there's a good chance that you are being paid wages. So you get a certain amount per hour. Now let's say you work 5 hours and you make $20 an hour. So you make $100, right? 5 times 20. That $100 is what we would call your gross pay. Now, you're not going to see that gross pay, right? Because there are deductions. So the gross pay is the amount that theoretical amount that you earned. And then in order to get down to net pay, you take out deductions. And in the US, you're definitely taking out federal taxes, and you're taking out some federal withholding and also some Social Security taxes, FICA. And when you take your gross pay minus your deductions, that gives you your net pay. Now, some common deductions. The employees are paying these amounts, right? Because these amounts are taken out of their payroll, out of their paycheck. So they're the ones paying these deductions. Employees pay federal and state income tax. Now, you might be in a state where there's no income tax, then you're lucky. But there's federal and state income tax. Sometimes there's even local income tax. Employees pay their portion of Social Security and Medicare taxes. And if you have a full-time job, you might, or even if you don't, you might be making contributions for health and other kinds of insurance. You might be making contributions to retirement plans such as 401ks. And there are other deductions that might be taken out of your paycheck, but those are the most common ones. So let's look at a very simple payroll entry. Remember that the gross pay is the debit to salaries expense. So let's say in this case, the employees earned $100,000. The deductions are the credits to the payables. So say that they withheld $20,000 from employees' paychecks, and then the employees paid Social Security FICA tax of $7,650. The gross pay minus the deductions, the $20,000 and the $7,650, gives us the net pay, and that's the credit to salaries payable. Now, if they're paying the whole amount today, that could be a credit to cash instead. All right? So the gross pay minus the deductions gives us the net pay. Now, employers also have to pay money because they have employees. So employers pay federal and state unemployment tax. They match the same amount of Social Security and Medicare tax that you pay. So remember that $7,650 before. They match that same amount. They pay that in also. And the employer may also contribute money for your health and insurance premiums and might match some of your contributions to retirement plans. So the employer makes a second journal entry after it records the salaries that we looked at before, and these are the payroll tax expense. So we're going to debit payroll tax expense, and this is the total of all your credits. And in this case, we just have two. This is very simple. The FICA tax payable, which is the same. Remember, that's the match that the employees paid. And then you credit unemployment tax payable, and that's the amount of unemployment taxes that the company owes. Add these two numbers together, and you get the amount of your payroll tax expense. Finally, let's take a look at using the times interest earned ratio to evaluate business performance. So the times interest earned ratio tells how many times a company earned enough money to pay its interest expense during the year. So what that means is a higher number is better, right? The more times the company earned enough money to pay its interest expense, the better. And the way it's calculated, and I put the parentheses here intentionally, don't forget to add before you divide, because otherwise, you'll run into some trouble. So you're going to take your net income, add back your interest expense, and add back your income tax expense. Take that number and divide it by the interest expense to see how many times the company earned its interest during the year. And remember that higher is better. So if the number went up from last year, that's a good thing. Okay, that's all I have. Don't forget you can watch the notes payable video as well, and I will see you next time.